India's Monetary Policy Committee meets this Friday after an unexpectedly hawkish guidance from the US Fed. So how will the Reserve Bank and the MPC think about this global sell-off, the rupee fall and the surge in US yields and the US dollar? And what will they do in terms of rate action? As always, CNBC-TV18 Citizens Monetary Policy Committee meets ahead of the official MPC to give us their views and their votes. Joining me now are the chairman of our MPC, former chief statistician, former chairman of the Statistics Commission, Dr. Pronab, and our members, Samiran Chakraborty of Citi, Kanti Ghosh of State Bank of India, Sonal Varma of Nomura, and Sajjid Chinoy of JPMorgan India. Gentlemen and Sonal, thank you very much indeed. I guess I will have to discuss a bit about the US Fed, but let me first start with the domestic impulses. Samiran, that to you. Do you think there are enough worries even on domestic inflation, even without the Fed prodding us?
So, Lata, to start with, I think the inflationary trend over the last 2-3 months have been somewhat benign. On a month-on-month sequential sense, things were coming off more or less in line with what RBI's forecasts have been. But what has changed a little bit now is that the Kharif crop advance estimates show that production will be significantly lower compared to last year.
4 million tons or something.
Yes, so that's now feeding into the cereals inflation, particularly rices and pulses. We are already seeing the month-on-month increase to be almost the highest in a decade for cereals. And now on the other extreme, there has been excess rainfall in certain areas, which is affecting the vegetable production and vegetable prices, which is showing up in the daily data as well. So both the cereal and the vegetable prices means that the September print, which was anyway supposed to be slightly higher than the August print, around 7.4, has more upside risk. And in consequence to that, the risk of the March inflation being lower than 6%, there's a risk that might not actually happen. So from that perspective, MPC will need to be a bit more cautious. And on growth front, there is enough and more signs that growth is still holding off at a pretty good level, which in turn means that the current account deficit problem could be more persistent, where India is growing at a much faster rate than the rest of the world.
Oh yes, that sums up a lot of the problems that growth throws up. But let me ask Dr. Sen the same question. Sir, how have you gauged the robustness of growth, even if it is skewed, and more importantly, if inflation is getting more entrenched than we thought?
No, in fact, I do have some concerns about growth. I think we are taking growth a little bit for granted, and I don't think we should, at least at this stage. And I can elaborate.
So just a word, sir. Credit offtake is like some, 9-10 year high, 16.2% when we last heard from RBI.
This is correct. So, but remember, all of that is in the face of actually fairly high inflationary numbers.
Yes.
And so that this is bound to happen, it's not surprising. But on growth, I think there are issues which we should be a little concerned about, not the least of which being the likely weakening in the global economy as we go forward. But as far as inflation is concerned, well, I completely agree with Samiran on that inflation, I think, is a less of a concern. There is some concern on the agricultural side, but now we are in a situation where we do not have an overhang of excess money supply in the economy. So the likelihood of that spilling over into core inflation is much lower today than it was earlier. So on the inflation front, I think a little more sanguine than Samiran does. On the growth front, significantly less so.
Oh, okay. Well, let me then toss this to Sajjid. Sajjid, if you looked at the import-export numbers, even if crude falls, it looks like our imports will be heavy. I was just looking at the non-oil import and the non-oil export. Non-oil imports has grown 30% April to August. Of course, with oil, it has grown 45%. So is not domestic consumption fueling imports? Should that be a worry for MPC and RBI?
So, Lata, I think it's important to just step back and look at the global backdrop here, because for the last 2 years, emerging markets have correctly been focusing on trying to alleviate the scars of the pandemic, providing as much support to growth and consumption as possible, both fiscal and monetary. But now the global backdrop will force a different repurposing of policy priorities at home. Just think of what's happening globally. The good news is that the global recession that we had all worried about 2 months ago when we did this in August, the odds of that have significantly receded. The US is showing much more resilience, both in terms of households and corporates. But the worrying part about that phenomenon is that the disinflation that globally one had expected is going to pan out more slowly, and developed market central banks will have to be far more aggressive going forward. And we've seen that across a number of central banks just in the last 2 weeks. So what emerging markets are now faced against is much higher global interest rates, the dollar, which is the strongest in 20 years. And even though commodities have begun to correct, as they normally will when the dollar strengthens, these are still relatively elevated. And this is the trifecta that emerging markets have to worry about. So I would argue, no matter where growth, what the growth concerns are, policy will have to pivot towards macroeconomic stability, because as you alluded to, in many emerging markets, higher commodity prices and the growth recovery have meant current accounts have ballooned to elevated levels. Fiscal policy in many emerging markets is elevated because of the response to the pandemic. And these twin deficits will force both fiscal and monetary to tighten. So I think the RBI will have to keep one eye on domestic inflation dynamics. I agree that at the margin, things have certainly improved, but the fact is we're still looking at 6% plus inflation for much of the next 6 months, and this is on the back of inflation being at 6% for the last 2.5 years. Again, the good news is inflation expectations have begun to harden, but what you don't want is for inflation to fester at these levels so that inflation expectations re-accelerate. So no matter what the growth concerns are, I think India, like many other emerging markets, will have to now pivot towards preserving and protecting macro stability.
Macro stability, exactly. So, Sonal, repeatedly the RBI tells us that, we only look at domestic impulses when we set interest rates, and the MPC is specifically mandated to only look at domestic inflation targeting. But can they ignore the Fed? I mean, will not US rates at 3.7 be the biggest input into the policy making?
Lata, I think it will be one of the inputs. It's not the biggest inputs. It needs to be seen in the context of the overall macro dynamics. So, for instance, in the last 2 months, clearly a much higher terminal rates in the US is a concern, and that in turn is triggering more currency weakness. So these two issues basically potentially call for higher policy rates in India. On the other hand, from a medium-term perspective, the hawkish Fed and recession concerns have also led to a decline in commodity prices, particularly oil. Now, there is uncertainty on how this pans out, but oil prices have come off. And growth concerns are rising. I agree with Dr. Sen. The forward-looking outlook on growth looks materially weaker. So it's the overall context. Net-net, I think that in a flexible inflation targeting regime, monetary policy has to focus on the indirect spillovers of a weaker currency. We still have ample FX reserves. There are lots of administrative and regulatory measures that can be announced to slow the pace of depreciation. Now, the current underlying inflation in India, even keeping Fed aside, is relatively high. The core momentum is running at close to 6%. So that in any case argues for more front-loaded tightening. But from a medium-term perspective, the domestic growth outlook looks actually much weaker, which should lead to a moderation in underlying inflation, although that hasn't panned out as of now. So I would separate the near-term versus medium-term outlook and front-loaded response versus what the medium-term policy response should be.
Okay. Well, then I am going to ask you both questions. What is the current rate action and what is the peak rate from the RBI? Soumya, I want to continue with this problem that the MPC may face, that we can't do things just because the global central bank is doing. Our mandate is domestic inflation. Now, what is the Fed telling us in the dot plot? That they follow PCE, they don't follow their CPI. Their PCE, their personal consumption expenditure inflation, they're expecting it to fall from 6.3 now to 2% or some 2.3% in 2024. But RBI has almost told us, the governor in various conversations, that our inflation will fall to 4 only in 2024. So basically it looks like our inflation is going to be more sticky, and in a couple of years it will be higher than the US CPI. Won't that be a factor?
No, I think, Lata, the bottom line is that if you actually look into the US Fed policy rate, assuming it goes to 5% as the Fed is saying, and if you look into the Fed CPI data, I think by the middle of next year, it is most likely that the Fed fund rate will be higher than the US CPI rate. So that will give some sort of a respite. But for the Indian context, I think the inflation trajectory currently shows that possibly 4% looks quite a difficult target to achieve in 2023. Maybe we can try that in 2024, because that will means a lot of disinflating the economy, which may not be an ideal case scenario for both the central bank and also the government. Because I think when growth has just picked up, I think maybe trying to take inflation quickly down to 4% may not materialize. So in that sense, I think the RBI will continue to be watchful. It will continue to front load the rate hikes. It has done the front loading the rate hikes. It has front loaded the liquidity management, the inflation projections, and I think the policy also, these policies, RBI will also try to front load the rate hikes and possibly try to get ahead of Fed curve, in the sense that when the Fed, if I look at the Fed dot plot, this year I think another 75 and 50 basis rate points are guaranteed. So I think the RBI rate cycle could continue till December. After that, it could take a pause and see how can take the inflation down to 4%. But as of now, the medium-term target is to get it down below 6%, because the mandate wants that it should be below 6%.
Yeah, no, but let me just extend that, Samiran. Don't you think the Reserve Bank has an immediate need to get to positive real rates?
I mean, it depends on how you define the real rate.
Typically, they are looking at 5%. So should we not, should it not be 1 percentage point higher?
What I'm trying to say is that if you're looking at defining real rate through expected inflation, then RBI is very well right in pointing out that real interest rates have already almost turned positive. But in certain exceptional times, your real interest rate might have to be calculated on the basis of actual inflation rate rather than expected inflation rate. If you take that sort of a view, then RBI needs to do more. In fact, even for Fed, the same thing holds, that in certain context, it makes sense to raise rates to the point of actual inflation. I don't think in Indian context we have reached that point where we have to experiment with that. But that will be a very critical policy question, that whether we have to get into that point where our policy rates will be higher than actual inflation.
Okay, actual current inflation and not expected inflation. Okay, from what you all are all saying, looks like all of you are going towards at least a 50 basis hike, or at least many of you. I have to take a quick break, but thereafter a bit of questions on the liquidity scenario, because we went into a bit of a deficit in the past week, and the vote and the stance, all that after the break.